Hello and welcome. Today is an interesting company we're going to be covering on all about your company. Now, it's a stock which has moved nearly 20% this week alone, and therefore we're finding merit in, maybe zooming out a little bit, trying to understand the company better and probably seeing where we stand as of today, both with regard to how the company's order wins are trickling through, execution is playing out, as well as where we see it with regard to valuations. This is this week, 20% jump on the stock price. So that's one reason why it's interesting. The second reason is it's inward facing, domestic facing, does have international presence, but more domestic facing, and which is why a company in the power space as well, there is likely to be a difficult summer in front of us, and therefore there's going to be an even larger need for power infrastructure to get fast-tracked, right? And this one sits at the confluence of that, power infrastructure and setup. EPC is what it technically does. So that's the second piece that keeps us very, very interested in a stock like this. It's also very fast growing on a very, very low base. It's a Bajaj Group company, and it's guiding for very sharp margin expansion. In fact, doubling of margins from Q3, which also has seen a significant expansion versus last year. In fact, versus the Q3 number, we're expecting margins to double by FY30. That is really the guidance that they've set themselves for. Now, let's try and get a perspective on what the company is all about. The first piece is it's a company which demerged itself from Bajaj Electricals back in 2022. It's a Bajaj Group company, I spoke about that, and predominantly into EPC projects in the transmission and distribution space with a strong backward integration. So that's really the sum and substance of it. Let's try and understand it better. In terms of within that power transmission EPC space, it does overhead transmission lines, air insulated substations, gas insulated substations, underground cabling and associated works, rural and urban electrification projects. Really, that's within that power transmission and EPC space, that's what it does broadly. In terms of manufacturing, it does manufacturing of monopoles, towers, high masts, which are basically just the kind of towers that you see, which are carrying the electricity cable lines, especially when you get out of the city, you'll see a lot of that. And that's what it actually manufactures in-house. And then they also do international EPC and export of the poles that they manufacture. And that also contributes very, very small amount, but does contribute to the revenue, but could be a presentable opportunity going forward. So like the international business combined could barely be single digit in terms of revenue contribution today, but the opportunities that lie ahead is really what we'll look at, because the growth that it's clocking is very, very sharp, and you'll get to see those numbers. In terms of capability, again, taking a step back, what is it capable of doing? It does EPC plus manufacturing, so it does both. So it does its design, EPC and commissioning. There is backward integration where steel fabrication, galvanizing and other manufacturing of tower monopoles, other products are concerned, because all of that is manufactured in-house by a Bajel Projects. Now, in terms of the business model, let's try and spell it out. Largely EPC, right? And therefore clients are utilities, large private developers, but they participate in tariff-based competitive bidding, win those orders that they win, which is obviously price sensitive. They try to target some of the niche parts within that supply chain, and therefore what it does, not too many people do or have the capability of doing, which allows them to win projects a little bit easily, because otherwise it becomes commoditized. At least that's the intention even going forward. And then they have to do end-to-end execution. Really, that is the crucial piece. In terms of geography, I did speak predominantly India focused. International revenue is low single digit. It's spread across 25 states, so large presence. The key presence is in Rajasthan, Gujarat, Madhya Pradesh, Maharashtra, Uttar Pradesh. And the international projects are in Kenya, Togo, UAE as well. And then there are others, of course. So we'll talk about the Middle East with the management and try and understand what impact that is seeing in terms of project execution. Let's talk about the numbers now. In terms of the last 2 years' numbers, and we're using 2 years because 2022 was the first year of demerger, and therefore we're using 2023, 2024, 2025 as the years in which we've really seen growth. So 98% CAGR is what revenue has grown by. of course, very, very low base and therefore, therefore you're seeing the kind of elevated growth. What lies ahead really is a question. That's why we've given this a neutral in terms of the growth path. It's very strong, but the base is extremely low. So that's something you want to keep in mind. In terms of the 9-month performance, you look at it and that's what you'll, okay, so that's the EBITDA trend. Of course, it was negative EBITDA, has turned positive. Again, directionally, it's going upwards. It's done a better EBITDA this, in fact, in the 9-month period than it has done in all of FY25. So EBITDA margins obviously getting better. But that's really the last year versus this year, 9-month FY26 numbers. Revenue has been flat. EBITDA has seen a growth of 73%. EBITDA margins have expanded by 160 bips. And then you've seen profit growth of around 7%. So that's broadly the way in which it stacks up. Now, let me talk a little bit about the margins and the order inflow before I talk about the margins. That's how the order book stacks up. 2,912 crore at the end of 9-month FY26, but it has won a 700 crore order 2 days ago, which is why you saw the movement on the stock. And in fact, since Q3, it has won nearly 1,500 crore of orders. That is large. That's nearly 50% of its current order book. This is approximate, of course. They give a range in terms of the order win and therefore approximate. But basically, the order book is very, very healthy in terms of the shape. The margins at 4% are a little bit, are a tad bit on the lower side because any pricing competition would put pressure, but it's on a very sharp increasing trajectory. So we want to understand, while I've given this a thumbs down, what we want to understand is, can it continue to go upwards? And if so, what is leading to that uptick? We'll get a rationale of that. And what will continue to lead to that uptick, and what is the linearity of the margin increase? Really, some of those things is what we'll try to gauge. But broadly, currently it's sub 4% in terms of EBITDA margin. The order book, of course, very robust at 4,400 crore. It's at 1.6, 1.7 times the current revenue. So you've got a decent visibility in terms of order book. So that is something that the company is built on. In terms of the balance sheet, and here's where it starts to get interesting. 525 crore is the total equity base. It's a 2,000 crore market cap company. So just sub 4 times is the price to book. The borrowing number is currently at sub 100 crore, so no concerns there. And then you have cash and bank balance of around 200 crore, which the company sits on. So that's broadly the way in which the balance sheet is structured. No concerns with regard to growth, at least on the balance sheet, on the face of it. Let's look at the cash flow. And mind you, this is a Bajaj Group company as well. That just adds to the fact that there's a strong balance sheet there. Now, in terms of cash flow, it's been decent. At least the conversion has happened, and therefore no concerns on that point either. Let's look at the return ratios. It's been sub 15%. Therefore, we've given this a neutral. But the guidance is they want to hit 15% plus by FY30. Now, that's a far cry away. We'll try and get perspective as to what keeps the management sanguine, if I can call it that, with regard to ROCE. Because if at all the growth clip is double digit, which is what is being guided for, then ROCE should see a sharp growth because margins are really increasing at a rapid pace. And if that were to happen, then ROCE should grow. So we'll try and get a perspective. Is capital going to get blocked in working capital? How is it playing out? We'll get a sense of that. But for the moment, we're neutral with regard to the return ratios, ROCE numbers. Excuse me. Let's look at shareholding. 63% owned by promoters. So no concerns whatsoever. It's the Bajaj Group, which is the promoter owner here. Very little FI or DI interest, and that's because it's a very small company, technically speaking. And then you have the public, which holds nearly 30%. In terms of goals for FY30, I've spelt out a few, but let me try and consolidate it, put it all together. Double-digit revenue growth is what they're gunning for. High single-digit EBITDA margin is what they're gunning for. So from the sub 4%, high single-digit, 8-9% maybe, 15% plus ROCEs. So of course, it's 15% plus, but ideally, if margins are to rise towards 9%, could it be 20% plus? Really, that's the question which I was asking. They want to be the leading EPC plus product player. So that kind of combination helps them. International business to be a larger chunk of the revenue is what they're saying. Play in the high voltage and niche segment. Really, that's what they're gunning for. In terms of valuations now, it trades at 90 plus times earnings trailing 12 months. Now, I've just made some ballpark assumptions here. Assuming an absolute 50% growth from FY25 to FY27. So if the top line were to go towards the 4,000 crore number with a margin of around 5%, PAT could well be closer to 75 crore, adjusting for interest and depreciation. And broadly, that will mean that the stock trades at around 27 times. That's the more realistic number. And thereafter, we'll try and chalk the path as to how this company will likely go. So while valuations look steep today, if at all execution were to play out over the next 2 years, and if that growth were to come, given that you've got a robust order book, you could well see this re-rate in terms of the price to earnings multiple. So we'll try and understand this and more. Let me bring on board Mr. Rajesh Ganesh, who's the Managing Director and CEO at Bajel Projects, joining us this morning. Mr. Ganesh, great having you. Let me first start off by, trying to understand what is it that that is keeping the order book so robust at this point. You've made a few order wins. Is it that your customers are investing heavily at this point? Did you just convert a couple of orders? And is that conversion really sustaining over the next couple of months? Are you forecasting that? Give us a sense.
Yeah, thank you. Thank you very much, Harsh. Thank you for having me on your show. That was an excellent presentation, by the way, so my compliments. To your question, the power transmission and distribution sector in itself is experiencing quite a bit of growth. As you yourself said, the usage of electricity in our day-to-day life is growing. And basis what is happening at a macro level, I think that will continue to grow even further. Electricity is going to find itself into applications that previously was not heard of, such as cooking and all the rest of it now going forward. So in that sense, there is a lot of tailwinds coming in the space of power generation and power transmission and distribution. The key bottleneck out here is really the transmission and distribution. There's a whole lot of generation capacity that's available, but in order to bring it to centers of consumption, what is required is to build that infrastructure to bring the electricity from where it is being generated to several places where it is being consumed. So to that extent, we are participating in the process, and these are businesses that are largely tender driven, and we are very picky in terms of which tenders we go to and where we play. So that's what we're doing, and the outcome is there for you to see, as you also presented in your presentation earlier.
Sure. Talk to us about how pricing and competition is evolving, because it's obviously a very, very competitive market out there. Talk to us about whether you're seeing extreme competition, moderate competition. How would you quantify it basis your business?
So we are flying at a much higher altitude, Harsh. We are not in the power distribution part of the business, which is rather crowded. We are in the extra high voltage, 400 kV and above substation line, as well as monopole. So that's the area that we are flying in, and it's not very easy for people to jump in and do projects here. I mean, you need credentials in order to do work like this. You need technology, you need expertise, and you need very good people. So to that extent, while the barriers to entry for new players is rather high, the existing pool is also quite strong. It's the competitors here are quite strong, and what we're trying to do is to sort of build a reputation for ourselves in the execution space. I mean, we'd like to be the company that executes projects on time. We want to do it safely. We want to do it on quality, and we want to do it within budget. So that's sort of the area where we are trying to differentiate ourselves, and that's the endeavor that we are on.
And what will hamper that execution, Mr. Ganesh? Talk to us about that. Will it be land acquisition? What will be the bottlenecks out there? Will to a certain extent it also be how commodity prices are evolving, and how is that going to likely impact your execution as well as your margins?
Yeah. Well, I mean, I can think of 2 or 3 things. One is commodity, as you rightly said, Harsh. I mean, you're seeing a rally on aluminium now. Copper is going up, steel prices are going up, and these are tender-based businesses that are, these are fixed term contracts, right? So that would be a big risk, and managing that risk is a big part of staying competitive. That's one. And second is, land acquisition is a huge challenge. Even though we don't take the responsibility to acquire the land, that onus lies on the client, but we do get affected by it, you see, because we want to build a reputation on execution. We want to build projects on time and hand it over and move on. But this sort of non-availability of land at time, ROW, I beg your pardon, right of way, becomes an impediment in achieving that. And also good people. You see, I mean, underrated, but it's a people business in many ways. And having good people is a competitive advantage as well. And and that's also a challenge, given at an execution level, the skill set that's available, and getting good people. But those are broadly, some of the big challenges that I see for the industry.
Okay. And Mr. Ganesh, you've clearly got a very strong order pipeline at the start of this year. What's hampered execution in 9-month FY26? Because on the top line front, I'm not going to talk about margins just yet, but on the top line front, you've been flat on the 9-month period. What's playing out? Give us some thought.
Yeah, sure, Harsh, absolutely. I mean, if you compare 9 months of this year to 9 months of last year, we're flat on top line. You're right, and that's intentional. To be honest, we're very careful to pick and choose. I can grow revenue very quickly in this area, you see, but it's important to pick the right projects that contribute to the bottom line as well. But if you look at the growth in EBITDA, I mean, that's quite sizable. Year on year, it's a 38% growth in EBITDA compared to the last financial year, and a 30% growth in EBT. We took a provision for the implementation of the new labor code as instructed by the government of India, and that impact was close to 7 crores, so just shade over 7 crores. So that's really what's played out. Other than that, over and above the challenges that I spoke about in terms of commodity, in terms of right of way, and in terms of people, there's nothing more beyond that that is an impediment, quite frankly.
Got it. And cost escalations, do you build that into your contract, or do you absorb that? How does it work?
Well, like I said, Harsh, I mean, these are fixed term contracts. I mean, some of the contracts have a price variation clause attached to it, but a lot of contracts, TBCB contracts these days, are fixed term contracts. So one has to be very, very careful in terms of bidding for these contracts, and the assumptions that we take going into these contracts, particularly on commodities and execution gang prices and all the rest of it, has to be very, very carefully done. And hence, you see us, being very circumspect about the projects that we take. You see, so those are some of the reasons, to be honest.
Hedge yourself then, Mr. Ganesh, in an environment like this.
So I'm sorry, I couldn't hear you. Could you say that again?
How do you hedge yourself in an environment like this,
right,
if I can ask?
Right. Sure, certainly, Harsh. I mean, for example, for aluminium, for example, I mean, which forms about a third of our supply cogs, we use hedging as a mechanism to keep ourselves safe. But there are challenges there also, Harsh. I mean, the time between participating in the tenders to getting an LOA is open space. I can't hedge at that time. I can only hedge after I get the LOA. And in a market like now, where the commodities are rallying, and that does pose quite a bit of a challenge. You see. So those are efforts, and what we are, as you rightly said, I mean, one of the things we are also doing is to expand our presence outside of India. As the audience and you probably are already aware, we've signed a joint venture to set up a business in Saudi Arabia. In fact, we've got a very strong partner on board there, and we are in the process of getting ourselves registered with the Saudi Electric Company. Now, these are and we are looking for similar sort of partnerships in other countries as well, which you'll hear about soon. Now, these are ways by which we are trying to expand the pie. You see, where we have an opportunity to perhaps make a little more margin. We have an opportunity to hedge a little bit on the quality of the order book as well. So these are some efforts that we are putting to ensure that we have a balance in terms of growth going forward.
Right, right. You've guided for margins to reach high single digit. You've already done very well on the margin count, despite the kind of headwinds you're seeing, and you've just described and we've just discussed. What's aiding margins at this point? Is it just scale? What's playing out?
Well, I mean, our the first task on hand, Harsh, is to grow the scale. As you yourself said, the scale is small, right? And there is an element of fixed cost absorption in this business, you see. So we have to grow scale a bit quickly. So while we picky and choosy about orders, I think given that the market is growing as well, so that's quite favorable. So we'll look to expand our order book, and hence things like the joint venture we have with Saudi Arabia, the partnership we have done with NIIF a week ago, in order to collaborate with them to support them in the efforts to sort of jointly bid for TBCB projects. And these are ways by which we are trying to push up the unexecuted order book with high quality orders. So that's task number one. Once we do that, I think we are also looking at cost. We're sort of going through it with a very fine comb, and making sure that we manage our cost better, be it commodity cost or be it execution cost. Or be it even administrative cost. I mean, these are things that we are doing to ensure that over the next 2 to 3 years, we should sort of be at a high single digit EBITDA margin. And as you rightly said in your presentation as well, we are currently at about 13% return on capital employed. We want to get to 15% pretty quickly. And then, yes, the aim is to go to 20%, as you rightly said. Over the next 5 years, we should be there. So you're spot on.
Makes sense. Mr. Ganesh, talk to us about execution, therefore. Does revenue ramp up now happen more quickly? Are all the drags behind you? Or do you continue to be cautious on execution? So that's my first question. And does cash flow conversion happen in a healthy fashion? Give us a sense of that.
Yeah. So two things there. See, one is that if you look at our execution, I mean, over the last sort of 9 months plus the 2 months thereafter, we've executed close to 17 projects this year, which is a record, really. And that's the sort of reputation we'd like to build. While understandably these are legacy projects which we want to get out pretty quickly. And so that the new projects that we have taken, which are at relatively higher margins, starts to flow in, and that will start showing on the numbers going forward. Second thing is that obviously one of the things that we would like to do going forward is to see if we can raise capital at some later point in the next financial year, to see if we can bring down our interest cost, which is a bit high now. We want to bring that down. We'd also like to make some investments in enhancing our supply chain and see if we can extract much more value further upstream in the supply chain. Because right now we don't have a relationship with re-rollers and all the rest of it, but we'd like to go there. And that's the next frontier for us to conquer, really.
Thank you so much, Mr. Ganesh, for coming in and speaking with us. It's good perspective with regard to how to look at the business. And viewers, that's all the time we have, unfortunately, on this edition of All About Your Company. Stay with us. More action to follow here on ET Now.